People watching this video are not going to understand why we're laughing. You missed it, Carter. We just had the most animated discussion. Both Nickelback and Kendrick Lamar. It was, yeah. All right. So happy Wednesday, everybody. This is actually a double Wednesday. So not only is this the Wednesday of the week, but it's the Wednesday of the year. By that, I mean tax day. It's tax day. So once every 6 or 7 years, tax day falls on a Wednesday, which is the worst Wednesday that you can possibly imagine. There was an upside to it, though. The Merriam-Webster word of the day on social media was audit. Can you believe that? Now, I know the reason for it is everybody's saying IRS audit. That's what we think about. I think audit, but I kind of called it a small victory for the non-tax vote that recognize that. So we are doing the very last presentation of the semester. We're going to be talking about Chapter 16. Before we get into it, I want to talk about next week. So next Wednesday is our final, or not our final exam, but our third midterm exam. And obviously, you know what the preparation process is by now. We'll be doing the exam review on Monday. Please make sure that you review the study guide and you review the exam itself, the preparation. I'm also going to let you know that I would encourage those of you who feel like you need the additional reinforcements to please come visit me in office hours, ask questions. My office hours are woefully underutilized, and by that, I mean that I do other stuff during office hours because I very rarely see students. That's not intentional. If you all came to visit me, I would be happy to discuss auditing. But if you if you feel that you need the reinforcement, please feel free to come and talk to me. I know that I'm a scary individual and kind of intimidating, but I promise I'm not like that in real life. So please feel free to come by my office, ask the questions. The only one that you might want to note, and I'll try to remind you of it, is the Wednesday of the exam day from 10:30 to 10:30 to 11:30. I've actually got an appointment. I'm on a search committee that I'm working on, and I'm not going to be in office hours for that hour, but I will be after that. So right before the exam, if you have questions, I encourage you to do that over the next week and not just right before the exam. But feel free to ask questions, and I would like to see everybody do well in the next exam. I know that you all have the capability to do it, so get that taken care of. All right, so what are we talking about today? We are talking about the latter part of the financing investing process. So we're going to talk about the two accounts that we have not talked about yet, which are going to be cash and investments. Now, you may say, Dr. Barnes, we talked about investments on Monday, and to some degree we did. We talked about investments on Monday. We're talking about what it is when other people invest in our clients. So debt and equity. The rules are very close to one another and very similar. The rules don't change that much when we're talking about investments from our client's perspective when they do investments in other things. So we're going to go a little bit more in depth and detail on that, but that's going to hold pretty close. But we do want to talk about cash. We want to talk about cash. Now, what do we mean by cash? Now, it's very, very generationally speaking is really how you define cash. And it's very weird because I still go to the ATM on a fairly, not regular basis, maybe once a month or so to get cash. It's very weird for me to talk to people says, yeah, I don't actually use physical cash anymore. I think that's very, very a pattern of the current generation to do that. But cash is going to be kind of omnipresent. And how we define cash is going to be really important from a reporting perspective. So what is cash? Well, obviously currency on hand, like boomers like me who still have a wallet and have vendables or whole currency in that. Cash in the bank account, which is more electronic in nature. And then if it's deposit, time deposits, and savings accounts, all of those would be appropriate. But if you go to a 10K, you will notice that there's usually an item that's presented alongside cash, and that's going to be cash equivalents. Now, has anybody ever done the research and said, what is cash equivalents? I've always seen this in the bank financial report, but I've never really defined what cash equivalents are. Well, from a definitional perspective, those are going to often be treasury bills or money market funds. But to actually kind of go down a little bit more detail, what does that mean? Basically, short-term, highly liquid investments that are readily convertible to cash, or they're very near maturity. So there's very low risk of them changing in value dramatically in the near term. So it's important to note that these cash and cash equivalents, they're frequently combined for presentation on the financial statements. Therefore, we generally audit them together, and usually that's going to be convenient because they're held oftentimes together with respect to how we look at them from a custody perspective. Now, let's just go ahead and go back to all of our processes we've talked about so far. Okay, we've talked about 6 different process areas. This is our number 7 process area, which I guess technically speaking, you could say financing, investing are a process of themselves. So I guess technically speaking, part of the fifth process area. But going back to all the lectures, if I talk about all the things that cash affects, which of those does cash impact? Does it impact the revenue process? Yes. Cash receipts. Does it impact the purchasing process? Cash disbursements. Does it affect inventory? Yes. Does it affect human resources? Yeah. Payroll. Okay. Can we say that it affects the things we talked about on Monday? We talked about long-term debt, and we talked about stockholder equity, even property, plant, equipment. All those are either acquisition or trying to acquire cash for use purposes. So cash affects everything. It's going to be one of those mechanisms that we use. So we've got cash right in the middle, and you will notice that the sources of cash, which is going to be kind of how we're going to be getting reimbursements for, and the disbursements of cash are all things we've talked about. So cash is the linchpin for an organization. And by the cash, the vernacular I'm using now is going to be cash equivalents. You could even make an argument that current crypto assets actually count as cash right now, although those are a little bit sticky subject. We're not going to go into a lot of detail about how we audit those because according to FASB's definition, those aren't actually cash. They're intangible assets. Now, don't get me started on that. Yeah, crypto assets, we could actually say exchange for cash. The problem is that they also kind of fall into other categories as well, so it's really hard to define them. Yeah, you will hear me rant about those at some point in the future, I'm sure. But for the most part, we're going to ignore that right now. We're just going to say cash equivalents. So when we talk about cash from an organizational perspective, is most of it currency on hand, or is most of it going to be something that's held at a different area? Well, if we're talking about currency on hand, like we're talking about actual physical cash, then we're probably talking about a minimal amount. So we're going to talk about that a little bit. But for the most part, we're going to be talking about cash that's held by a different institution. Usually those are going to be financial institutions, or the vernacular we use nowadays, banks. Yes, okay, banks, okay. So we need to understand what it is that we have to do to be able to audit bank information. And we have to understand first, what are the types of bank accounts that we're concerned about? Now, the easy one is a general cash account. That is kind of the major flow of operations for an organization. Operational and even some financing investing degree are going to be held in general cash accounts. This is usually one for smaller organizations. That's the main source of cash. For large organizations, it's going to be a consolidated source of cash. Then we've got something called, let's actually go to the one on the right. Let's go to branch accounts. Okay, so branch accounts. Why are branch accounts listed here? And the answer is for really large organizations, it may not be practical to operate through the same general cash account that they operate from. Let's use an example, okay? I'm just going to say, I've never looked this up and I probably should, but I always use this as an example. Let's say Walmart has a general cash account through Bank of America, right? Which is probably not far-fetched, they probably do have, but let's say their main cash account is through Bank of America. So if the Walmart here in Kirksville wants to get cash, they have to go over to the Bank of America, the nearest branch for Bank of America, and withdraw cash so they can actually use it for operations, which is probably pretty straightforward, right? Everybody see a trap that I'm going in here? Has anybody been to the Bank of America here in Kirksville? There is no Bank of America in Kirksville. Yes, this is why they have to have branch accounts. They have to operate through other banking systems in order to be able to do operations, especially for large organizations like that. So that's what we mean by branch accounts, are those ones that are held separate from the general cash account. Then we have this thing called impressed cash accounts, okay? So has anybody heard the term impressed cash account before? Or heard that terminology? So oftentimes organizations will set up specific bank accounts for specific purposes, all right? Certain bank accounts for specific purposes, what I meant to say. An example of this might be something that's set aside for payroll for a third party. So say, for example, you outsource your payroll service and you have to actually put money into an account to fund that payroll. And then the company that does the payroll service will withdraw from that account. That account cannot be used for any other purpose other than the deposit and withdrawal of funds for payroll. There should be no other cash flows associated with that. So impressed cash accounts are for a specific purpose, but because they are for that purpose, they're generally very easy to audit because we know exactly what the purpose should be and we can track the transactions exactly specifically. All right, moving on, control risk assessment. Control risk assessment. Let's go ahead and get into this. So for control risk, oh, by the way, I didn't put an inherent risk slide up here, but what do we think about the inherent risk associated with cash? So do you think there's high inherent risk or low inherent risk with cash? The answer is yes, okay? It has, with respect to whether or not we're concerned about misstatements in the financial statements, it's very, very low risk generally because it's very obvious to identify that there's going to be disparities. Now, take that with a grain of salt. There have been companies that have misrepresented their cash position and gotten away with it, but it's very hard to do. It's very challenging to do. That being said, is that the only type of misstatement that could occur? Well, could a theft of an asset be considered a misstatement? How easy is it to steal cash? You see a wallet lying on the ground, it's like, oh, free money, put it in your pocket. That's pretty straightforward. That's not really theft. That's just taking advantage of an opportunity. Ignore that I said that. All right. But if you saw cash just lying around and you didn't know who the party was, you could steal it pretty easily. I mean, it's just kind of by definition, because it's a bearer instrument, it's very susceptible to theft. So inherent risk is going to be, it really depends on the situation we're talking about. It depends on the circumstance. But we're going to get a little bit more into here. So. All right, so control risk assessment for cash receipts and cash disbursements. Have we talked about control risks related to these concepts? The answer is yes, we have. Covered in chapters 10 and 11. So good news is most of the things that we need to cover with respect to controls in this area, you've already studied them because you've been diligently studying those tables that I told you to study, right? Everybody nod your head. I don't want to see anybody shaking their head right now. Yes, okay. Everybody has been studying those and are prepared for the exam. But there's an additional cash control, one that you're already familiar with. So what did you learn about how to track cash back in 302? What was that thing called? The bank reconciliation. Remember bank reconciliations? Everybody does those pretty thoroughly for their personal accounts, right? Right? Don't shake your head. Don't shake your head. Gives me a bad impression. All right. So yeah, we're going to make sure that we do bank reconciliations. So why is this important? Well, if the client has effective bank reconciliation procedures, the auditors can choose to test these reconciliation procedures for its test of controls. Now, this is going to be an important point because we're going to talk about how to test bank reconciliations as auditors. You're also going to do a more complex one for your homework. I do want to say that I don't particularly like this EWC exercise because it's needlessly complex, but it does do a good job of reinforcing what we're going to talk about. That being said, please, for Friday's homework, make sure you read the instructions. Please do not submit the entire Excel workbook, just the summary page is all I'm looking for. Because it is a massive Excel workbook, and you're saying, oh, that means it's going to take a long time. No, it takes like 5 minutes because you basically have to click one box in every single Excel page, which is why I don't want the entire Excel workbook submitted because it's usually like 1 or 2 boxes in every tab. So yeah, we can test the bank reconciliation procedures. Now you can count yourselves lucky because in the past I used to teach my students not only how to redo bank reconciliations, but also how to test them. We're just going to focus on the part that relates to testing bank reconciliations. And it's not too difficult. It's going to reflect on something we've talked about before. We'll get to that, though. Let's talk about substantive analytic procedures. And our good friend, Dwight Schrute, he asked the question, does cash have a predictable relationship with other financial statement accounts? What does Dwight always say? He says false. He says false. So think about this logically, okay? If we're talking about cash, what can affect cash? Well, quite literally, everything that we listed in this slide right here. So if revenue changes, then cash can change, but so can sales of property, plant, equipment, issuance of long-term debt or capital stock, any purchases we make, payroll, long-term debts. So if I'm trying to find a relationship between one account and cash, is that likely to be effective? Not really, okay, not really. You could develop one very, very complex model, and even that's probably going to be subject to really to difficulty. So false. So that's going to mean that we cannot usually model cash using an analytic procedure. By and large, analytic procedures are not useful for testing cash, is what we're trying to get to. So our use of substantive analytic procedures for auditing cash are generally going to be limited to comparisons with the prior year's balance, because we can do that all the time. We can look at trends and comparisons with budgeted amounts. Okay, comparisons with budgeted amounts. So that's basically it. That's all there really is to it. All right, moving on. We've got our some of the tested details. We're going to be testing all of our assertions here. This is weird. So I've got authorization listed there, which is obviously weird because I don't think authorization is a real assertion. But if you look at account balances, I've got rights and obligations crossed out. Why are we not concerned with rights and obligations with respect to cash?
Pure cash.
Yes, cash is what we call a bearer instrument. It's like if you have the cash, you own it. All right. So the rights are defined by who has possession of the cash. Now, you may say, what about the bank? Does that mean they have ownership? The answer is kind of, okay? They're held for custody and there's a legal title to it by the organization. But for the most part, possession of cash is representation of ownership of the cash. So we don't concern ourselves with the rights and obligations of the cash. All right, and these are going to be some examples here for examples of how we can do substantive test transactions. You can refer back to this slide, but this slide should look really familiar because this is just reflections of what we talked about back in chapters 10 and 11 with respect to substantive tested transactions. My most important area here that I want to talk about is I want to talk about what it is that we're going to do with respect to how we test the bank reconciliation procedures. So we're going to be able to test multiple assertions in this area. We're going to test existence to make sure the cash exists, and we're also going to test completeness and VAA by looking at some items. Now, I don't want you to focus too much on what's listed here because we're going to go through each of these steps. Moreover, the terminology that's used in this slide is really troubling because they use the word trace multiple times when it doesn't actually imply the test of completeness. It's testing more for VAA in those situations. I'm going to get to that because I got a little bit of a rant to share with you. It wouldn't be a last lecture if I didn't have a rant, okay? But let's go ahead and talk about the details that you do need to know. So these are the things that are important to remember. So here's what I'm going to talk about. We're going to talk about bank reconciliation testing. There are going to be 3 items that you need to know. First of all, what are the names of the items that you need? And then what do those items represent? So you need to have a detailed understanding of those, which you will get because we're going to do homework and we're going to review this items in the slides. There's going to be 3 additional items that we're going to talk about for extending bank test or cash testing. You only need to know the names of those. You don't need to know what they represent. Okay, so there's going to be 6 items in total, 3 of them detailed understanding, 3 of them just memorization. So what do we need to know for how we're going to test the bank or the bank reconciliation? The first one is going to be obviously a copy of the bank reconciliation. You cannot test the reconciliation without the reconciliation. We do not live in kind of the divine paradise where we can actually look at things that don't really exist. So we need to make sure this item actually is in place so we can test it. Now let's go ahead and talk about what the reconciliation is designed to do. So remember on the reconciliation, you've got 2 sets of balances. You've got the bank balance and you've got the book balance. Which one of those is represented in the financial statements? The book balance, right. So the bank balance is going to be different in almost all situations. It's going to be different from the book balance. So we've got a whole bunch of items in the middle that are used to adjust for those. Oftentimes those are going to be checks that are outstanding, deposits, or outstanding checks, deposits in transit, or deposits, outstanding deposits. I always get those confused. Checks outstanding, deposits in transit. And then we've also got adjusting items such as like bank charges and fees and non-sufficient checks and stuff like that. You don't need to worry too much about whether those adjust to book side or bank side. These are all going to be kind of one conglomerated area for our purposes. But it's important to think about this, what it is we're trying to determine. We are trying to validate that book balance. Remember what we talked about with respect to fixed assets or property, plant, and equipment on Monday? We said we're trying to determine the ending balance. How did we go about doing that? We started with a beginning balance that we knew was correct, and then we tested all the changes in the middle. So we knew the beginning balance was correct because we had audited in previous period. We looked at additions and disposals. Those were all the changes, and that gave us, mathematically speaking, the ending balance. We can do the same thing here with our bank reconciliation. If we can determine what the bank balance is, and we can validate all of the adjustments in the middle, that mathematically gives us the book balance. So it makes reason that if we're going to be doing our adjustments, that we want to identify something that will validate this amount up here, and then something that will validate these items down here. So let's talk about the easy one. What is the easiest way to validate this balance right here? Now, before you say bank statement, I know everybody's thinking of us like bank statement, Dr. Barnes. I know I've seen a bank statement before. It's like, well, I appreciate where you're thinking, okay? But let's assume that we're not waiting on the point in time when a bank statement is issued. Let's say it's April 15th right now, which is the middle of the month, and we want to know what it is right now. What would be a way that we could request information from a third party? Confirmation, yes, we call that a standard bank confirmation. This is going to be one of those positive confirmations that we're going to send out to know what is the cash balance of the account. We're going to determine what is going to be the items we say. So this is going to be traditional, like we do for other confirmations, where we'd say, can you please tell us what the item is or what the amount is? Or we could actually provide that and have them confirm it. It could be either a standard positive confirmation, or it could be a blank confirmation. Either one would be appropriate here. But we're using this to determine that bank balance that occurs at the very beginning. Now, going back to our original bank reconciliation, what we still have outstanding are going to be these items that are adjusting here. Now, let's assume for a second these are all valid items. Do these just represent timing differences? Timing differences between what the bank recognizes and what the books recognize? Yes. So logically speaking, these should fix themselves if given enough time, correct? So let's assume that we could look forward a period of time, maybe 7 to 10 days in the future. Could we actually determine whether or not these are valid items, whether these are checks that were legitimately cleared, these are deposits that were actually in transit that were going to be eventually hit in the bank account? The answer is yes, and that's going to be our third item. This is going to be called the cutoff bank statement. So we want to have the date of the last bank reconciliation, whatever that date may be, and then we're going to ask for a statement for 7 to 10 days in the future. And presumably, all of these items that are still pending transactions either going to be adjusted by our client, whether that would be like a journal entry for bank fees or NSF checks or whatever, or they're going to hit the bank and they're going to be cleared eventually. So think about this from the audit perspective. I'm concerned about these checks that are still posting and these deposits. And I look and see, all right, this check cleared, this check cleared, this check cleared, this deposit cleared, this deposit didn't clear. That would be a cause for me to actually ask questions, say, why did this deposit clear? It's been 7 to 10 days and it should have cleared by now, especially in this day and age. Keep in mind, this is kind of archaic terminology to say 7 to 10 days. How long does it usually take a check or any electronic transaction or deposit to clear and hit the bank? Yeah, usually 2 business days. Yeah, so it's usually a pretty short period of time. So 7 to 10 days is plenty of time for that to happen. What does that signal to you if you're the auditor and you look like a week later, it says this still has to clear? Either there's mitigating circumstances or it could be fictitious. It could be something that's problematic, which is why we include that. So just to recap, if I ask you, what do you need to test the bank reconciliation? The first thing you need is the reconciliation. Second thing you need is the standard bank confirmation to validate that top balance in the bank reconciliation. Third thing you need is the cutoff bank statement. So make sure you understand not only what those items are, but what they're intended to accomplish, what it is you need. Now, the bank reconciliation is pretty obvious. You have to have a bank reconciliation, test the bank reconciliation. So the last 2 are the really important ones. So what are we going to be doing as part of this reconciliation? Well, first of all, we're going to verify mathematical accuracy and create the books to the general ledger. We're also going to agree the bank balance of the reconciliation of the balance show of the standard bank confirmation. Now, if you go back a few slides ago, you will notice this word is trace in the slide. I've specifically chosen this term, and we'll see why here in just a second. All right, let's see why here in just a second. Wanted to compare the deposits and transits to the bank reconciliation of the cutoff bank statement, compare outstanding checks on the bank reconciliation with the canceled checks into the cutoff bank statement for proper payee amount and endorsement. This fourth one is really kind of interesting. So we could use our cutoff bank statement to validate the checks and see if they've cleared. But has anybody ever written a paper check and seen what a canceled check looks like? Usually the bank will either send you the physical checks themselves when they clear, or they will send you a copy of that saying this check cleared, and you can see that we finally posted this check. So if it's going to be a physical check, and this would apply to a formal electronic transactions as well, we can look for canceled items associated with that. We don't agree any charges on the bank statement to the bank reconciliation. So these are going to be items that we want to make sure are cleared on the bank reconciliation that have been posted. And agree the adjusted book balance to the cash account lead schedule. This is the kind of last one's kind of important. Because remember, what we're trying to determine, I don't know why I've got that on. Okay. Agree the adjusted book balance to cash lead schedule. We're trying to determine if this book balance is correct because this is supposed to be what's represented in the financial statements. This is what we're supposed to be ultimately determining. If we go to the reconciliation and this amount is different from what's in the cash account lead schedule, which is what flows in the trial balance of the financial statements, we've got a problem because we're not testing the right number. So that's basically just an agreement there. Now you'll notice that there's a lot of agreements that's going on here. Now this is intentional because when we talk about tracing, we're going from source to record. When we talk about vouching, we're going from record to source. When you hear the words agree and compare, which we've heard a lot in this course, this is generally going to be source to source. Now, from a controls perspective, this represents document matching. We talked about like 3-way, 4-way match. We can actually work in directions on those, but that's not as relevant here. What we're talking about in this situation is trying to validate information by looking at parallel information. So an example here would be looking at the bank balance on the reconciliation of the balance shown in the standard bank confirmation. Reconciliation is one of those source documents for us as auditors. This is just a verification of that information. It's not moving in a direction. They're just kind of parallel to one another. So keep in mind the terminology here is there's a reason why I'm fretting on the terminology, because when we're doing agreement or we're doing comparisons, that's usually a signal that we're testing valuation, allocation, accuracy, whereas tracing and vouching are generally going to refer completeness and existence occurrence. I'm not going to try to split too many hairs on the exam. This is a really confusing concept, which is this is me being paranoid. But there's a reason why I get really, really wound up about the terminology it's used, just because I don't think it's used correctly in some situations. All right. What if the client does not have adequate controls over cash and the auditor suspects some type of fraud involving cash has occurred? Answer is we leave the client. We're not going to stand for that. Actually, that's not true. That's not true. Okay. So this is where we're going to be doing additional procedures. This is where we're going to be extending the audit procedures over cash. Now, like I said, there are 3 procedures here. If you really want to know more about these, you can come to my office and talk to me about them. I'm happy to share these with you. But for the most part, you just need to know the names of these 3 items for the exam. Okay. So what are these 3 procedures? Extended bank reconciliation procedures, which is basically just looking at a bank reconciliation procedure or bank reconciliation over a period of time instead of looking at them at a point in time. Then we've got proof of cash, which a proof of cash is looking at what the additions and subtractions were during the period to actually validate the amounts that are correct. We do that over a longer period of time as well. And then test for kiting, which kiting is one of those really, really weird things that doesn't occur anymore nowadays. It used to occur quite frequently more when most organizations did operations, but mostly by paper check. If you actually are associated with an organization that does a lot of paper checking transactions, this is a vulnerability that you might be aware of. But for the most part, it's kind of difficult to do nowadays in the day of age is electronic transactions. All right, so some additional notes regarding cash. So first of all, auditing an impressed cash account. So the example is that payroll account that I talked about. They usually follow the same basic steps as auditing a general cash account. So we don't really need to learn anything more. In fact, it's usually easier to audit an impressed cash account because there are fewer transactions and they're generally for specific purposes. So testing the individual transactions are not actually out of the question. Also, has anybody heard of petty cash? Yeah, petty cash is that cash that tends to just say things that are really abusive and hurtful. It's very petty. Now, petty cash is used to pay for minor expenses. Okay, used to pay for minor expenses. So this is where I kind of do story time in here. It's like there was this movie back. We were talking about going back in the 90s. There was this movie back. I think it was like 1990 or something like that. And Christina Applegate, who I had a massive crush on at the time, and she was starred at that time. She was in this called "No, Don't Tell Mom the Babysitter's Dead," and she's the heroine of the entire movie. The heroine of the entire movie. Guess what she does? She steals petty cash to pay for her family's expenses. Okay, because that's what heroes do. That's what heroes do. Is they steal petty cash. There's no relevance to this lesson whatsoever. I just wanted to tell you that that's how they wrote movies in the 90s. People who stole money, they were the heroes of the movie right back then. It's actually a lot more complex and detailed than that, but I'm not going to go into the plot of the movie in class. Anyway, we're talking about petty cash. Do we want to perform substantive procedures over petty cash? The answer is no. The reason why is simply because petty cash, by definition, is not material. Generally going to be very small in scope. What we are going to do is we are going to test controls in this area to make sure that there's proper custody, authorization, or recording of petty cash transactions. Segregation of duties is just an easy way to ensure that petty cash transactions do not get abused the way they were in that movie, okay? And if you ever have the misfortune to watch that movie, I apologize. Again, I admire Christina Applegate, but that movie was garbage. It was just awful, awful. Anyway. So what are some disclosure issues for cash? So a few things you want to know. Want to know what the policy for defining cash and cash equivalents are? This doesn't vary heavily from organization to organization, but it can vary, especially if we're talking about non-issue organizations. Any restrictions on cash? This is a sinking fund requirement. What's a sinking fund? When there's a quicksand and sinking fund is basically when cash is set aside for a future project. So like you've got a construction expense and you say, we're setting aside $10 million every year for the next 10 years to fund this obligation. That would be an example of a sinking fund. There are contractual obligations to maintain compensating balances. We've actually talked about those already. Cash is often used as a measurement of financial health in organizations, especially liquidity. So an organization may have to have a certain amount of operating cash flows in order to be able to maintain contractual obligations. Particularly lines of credit would be an example of that. Cash balances are restricted by foreign exchange controls. This one's, again, less relevant than it used to be because foreign exchange operations tend to be a lot more transparent and a lot more frictionless than they used to be. And any letters of credit that are associated with organizations. So that, in a nutshell, is cash. And for the last part, we're going to talk about investments. Now, like I said, for investments, a lot of this is going to seem repetitive of what we talked about on Monday. That's not necessarily a bad thing. That means there's a reinforcement. So what do we mean by investment? Common stock, preferred stock, debt securities, hybrid securities. But the difference being, this is not our client issuing these items. This is our client investing in these items. which most organizations will have some type of investment, especially a large organization. They will hold these investments as measurements of ownership in the organization. So our rules are going to be very similar. Sorry about that. All right. So what are we going to be doing as far as the audit goes? Well, for a client with a large investment portfolio, we're likely to follow a reliance strategy. In other words, what this means is if we think that we as the auditor or we as the auditor are auditing a client that this is part of their core business model is to maintain and engage in investments, then this is going to be likely something that they have a lot of transactions in that area, and we are going to need to rely on controls to some degree. But if we're talking about your normal organization, these are very large transactions that occur infrequently, which sound very similar to what we talked about with PP&E, we talked about with long-term debt, we talked about with respect to stockholders' equity on Monday. So the same rule is going to apply. As long as we're not required to test them under ICOFR, we can use a substantive strategy. All right. So what are some areas of concern that we have with respect to assertions over controls over investments? So with respect to completeness, want to ensure that all transactions are recorded. All right. Now, this is probably not going to be as relevant here because it's not often that you will have $10 million transaction and say, well, yeah, we just didn't record that one. It just didn't feel like it. I mean, unless your organization's named FTX, but from my knowledge, they're no longer in business, so it's not a big deal. All right. What about existence occurrence? This is probably going to be our key assertion in this area. We're going to talk about how we test this. Why did I say this is a key assertion in this area? Something I've been hammering on for like the past 3 weeks.
On assets, but
So it's the other way around. It does
Okay, the other way
asset. We're talking about investments. So yeah, we're talking about investments in the client's assets. So we're talking specifically about concern over an asset or revenues, in this case, the assets. Okay. If we're talking about long-term debt or talking about equity, that's when we get to completeness. We're making sure they get fully recorded. That would be our primary of concern. For opposite reasons, we want to make sure that those get fully recorded. So we want to have controls ensure that the purchase and sale of any investment is properly initiated. We also want to make sure that the investment themselves actually exist, but that probably is fairly intuitive. That's probably pretty straightforward to say. I don't know why I have authorization on here, but I think this has to do with the fact that this has to do with assertions and controls, not just assertions. But we want to make sure that any initiated purchase or sale investment is properly authorized. That probably goes without saying. But again, this is not one that I would expect you to know from an assertions perspective, but it's important from a controls perspective. VAA is a pretty heavy concern with respect to investments. We want to make sure the appropriate amounts are used to value investments for financial statement purposes. You guys have taken some financial accounting classes. How easy is it to value investments? Oh, it's really simple, Dr. Barnes. I could do it right now. No problem. Yeah. So do it. Prove it. I'm going to call you out on shenanigans right there. I know I'm putting words in your mouth. So can we say that maybe some complexity associated with this particular task? Yes, we're going to get into that here. All right. Presentation controls ensure that securities are properly presented and controlled or disclosed, and control ensures classification ensures that securities are properly classified. This is interesting. We talked about all the assertions, the transactions and events. I even threw in an authorization just because, except for one. I was missing one of our assertions that usually is thrown up here. Which one am I missing? Didn't know that I was going to throw that at you. I said, oh yeah, okay. So we said completeness, existence, occurrence, authorization, VA, presentation, classification. What's up? Cutoff. We're missing cutoff. Why are we not so concerned about cutoff with respect to investments? What is the likelihood that we're going to have a large investment that's going to be reported in the correct period? Visibility on that's got to be incredibly high. So the transparency is really there. So we're not really concerned about cutoff being an issue here. Now, could cutoff feasibly be an issue? Are there situations? Yeah, it could. But for most pragmatic purposes, we're more concerned about these other risk areas. All right. So what did we say about equity with respect to controls? What was our primary control with respect to equity? I said the true this is really, really important. One of my favorite things to talk about with respect to controls. Segregation of duties. Yeah, CAR. Okay. If that is true for equity, do we think that it might hold true with respect to investments as well? Yes, it does. And the reason I mention that is because the next slide talks about that specifically. Okay. So what are some key segregation duties for investments and possible areas of fraud? So initiation function be segregated from the final approval function. So one individual is responsible for initiating and approving the securities transactions. Fictitious transactions, securities can be stolen. We haven't talked about this. I've not told you specifically what these roles are, or have we? Have we? We may have in another context. So initiation could be like a requisition. Could we talk about something like that? So initiation sounds like a requisition. What do we say requisition was back in the purchasing process? It's going to be CARR. It's going to be R. It's going to be recording. Boy, I really have to give it to you guys this time. Yeah, so if you're recording, initiation would be a recording function. And then final approval. This one should be a little bit easier. Authorization. So recording and authorization be separating out. Valuation monitoring function should be separated from the acquisition function. So valuation monitoring, that one's a little bit more subtle and distinct, but I think that's more of a recording function, whereas acquisition is a lot more straightforward. So these are assets, and we're saying somebody acquired the assets, and we're probably talking about custody. Okay. We're going to skip this next one because it's just a double reporting function, which we say is going to be different levels. That's kind of our redundant control. And responsibility for custody of securities separate from the accounting for the securities. So custody of securities, what is that? Custody. Very good. Very good. I didn't have to give you guys that one at all. Yeah. And then that from the accounting for the securities. So accounting is going to be recording. So separating out recording of the securities. So again, these are fairly straightforward if you think about them from the lens of what we talked about before. But again, please be familiar because segregation of duties for these investments and to that respect to that equity are really important. We have to make sure those responsibilities are separated out whenever possible. All right. Substantive analytic procedures. Substantive analytic procedures can be used to evaluate the overall reasonableness of investments and related income statement accounts. But usually these are going to be looking for trends over time, which seems to be a recurring theme in these sections. So we can actually use ratio and trend analysis, but model development is generally not going to be helpful. We're going to talk about why here in just a second. Okay. So comparison of balances with the current year's investment accounts with prior year's balances, comparison of current year's interest and dividend income with reported income for prior years and expected return on investment. And we can recompute interest income using the face amount of securities held, interest rate, and the time period held. This is interesting. No pun intended. Just came to me. Anyway, so we talked about interest expense with respect to bonds. Does it hold true that we can actually recalculate interest income in the same way? Yeah, it's just the flip side of the coin. If we're to the ones who hold the bonds, as long as we have the information associated with what the bond rate is, what the life of the bond is, and the information associated with that, the bond value, then recalculating interest income should be very straightforward and very easy for us. But you will notice there were two words in the second bullet point, interest and dividend income, and then there's only one word here, interest income. Why are we not doing a same model to recalculate dividend income? So let's just go think about this from a common stock perspective. You may say, well, I only think about preferred stock, Dr. Barnes, because I'm very highbrow, but so let's assume for common stock. Dividends on common stock. What do we know about them? What's that? You don't, well, you can get them, but they are not
consistent or guaranteed.
They're not guaranteed. Okay. They're not guaranteed. We can actually receive dividends, but it's usually just whatever the judgment of the organization holds it. In fact, a lot of organizations, they don't pay dividends out simply because they don't want to get in the trend of having to pay dividends and reduce their retained earnings. So there is that argument. Now, if we're talking about preferred stock, usually preferred stock is held by a percentage afterward. You remember that from financial accounting? Remember, like preferred 5%? What does that 5% mean? It means you're paid an annual dividend of 5% of whatever your preferred membership is. So those are guaranteed. But we're talking about common stock. We can't actually guarantee dividends. Does that make it difficult to develop a model for expectations on dividend income? Yes, which is why we don't have modeling here. So I was saying that there are limitations in what we can do for reasonableness. We can calculate and model interest income. We cannot model dividend income. All right. With respect to our sub-adjusted details, we're going to be talking about all of our assertions that are with respect to our account balances. So that's basically everything other than cutoff and authorization, obviously. But there are some that are more important than the others. And I want to talk about those specifically because those are the ones that I'm likely to ask you questions on. So by and large, which do you think would be the most important assertion with respect to investments? And I'll give you a hint. I've been harping on this the entire 3 weeks saying, if you look at the category that I'm talking about, the account category, you can answer this question very easily. So existence occurrence, okay? Existence occurrence, you may say, wasn't VAA more important? Stop it, okay? Existence occurrence for assets and for assets and revenues, completeness for equity, debt, and expenses, All right, that's what I want you to remember. So let's talk about existence occurrence first. So how do we verify existence occurrence? The best answer would be is that if our client holds the custody of these particular securities themselves, or if they have them like in a bank safe deposit box or something like that, we can go in and physically examine the securities directly. So if you had your hands on the actual certificate for the investment, would that give you a lot of assurance that this investment actually exists? Hopefully so. But there is a possibility that our client does not have physical custody of the investments. What would be the next best item if some third party had custody of the investments? A confirmation, a third party request. So it might be the issuer still holds them. There may be a separate custodian, somebody who's actually specified to hold the securities on behalf of the client, a broker dealer, somebody who actually negotiated the transaction, or some other counterparty that's actually got ownership or custody, but not ownership. We can also read executive partnerships or similar agreements, but these are again going to be more explanatory. We generally are going to rely on more on the physical examination or the confirmation, whichever is going to be appropriate for the issuance. All right. So now, what do you think the second most important assertion is? I gave you the easy one, existence occurrence. What do you guys think would be the second most important assertion with respect to securities? I'll give you a hint. This is the one that you had to struggle with learning how to actually do this back in financial accounting. VAA, how to value these securities. Okay, so we want to know primarily, have there been any changes other than temporary to the fair value of the investment? So keep in mind that securities do need to be negotiated at fair value and adjusted to fair value. Okay, so let's use for example that the fair value has dropped significantly below cost. Under GAAP rules, is our client required to report the investment at a new fair value or write down? Answer is yes. If the investment has been impaired, security should be written down and a new carrying amount established. Now, you may say, what if the value has gone up? We're going to get to that because the rules for going up in value are a little bit different. That depends on something else associated with that, which is going to be our third concern area, our third assertion. So, are all investments the same? Are all investments created equally? No. So, are some investments going to be sold in the very near future? Yeah, we call those trading securities. Some of the investments, they will never be sold. They're going to be held to maturity. Some of these are available for sale, but not intended to be sold in the very near future. Okay. So there's like multiple categories of securities. What's another word for categorization? Classification. Yes. Okay. So presentation and classification. I put presentation up there because that has to be part of the gap as well. But classification is the main concern in this area. So we're talking about the different categorization. Held at maturity and available for sale securities should be classified as non-current assets unless they plan to convert them within 12 months. All right. So it's important to note that how we actually recognize those is going to be important because trading securities are classified as current assets. Now, we've talked about this necessary classification distinction. It's really important because, first of all, not only does this dictate what our valuation mechanisms are, if something's going to be a trading security, then it's going to be treated differently than it's going to be than if it's going to be a held to maturity or available for sale. I always get this wrong. I know I've got my notes on it somewhere, but I always get this wrong. I know trading security is going to be ordinary income. Held to maturity, I believe, is OCI, and then non-current assets, I believe, is held as operating income. But again, I'm not going to test you on that because I don't remember it myself, which tells you how much I've been paying attention to what Dr. Eisen tells me. He usually talks and I just kind of zone out. So does anybody else do? Don't raise your hand. Don't raise your hand. Don't raise. Anyway, so what is important for this particular class? What do we need to know? Well, why are we concerned about this as auditors other than from a valuation perspective? Well, what was our concern with respect to classification of assets with respect to revenue and purchasing? We were really concerned about making sure that they met certain covenants or certain obligations. So remember we talked about liquidity covenants such as current ratio or working capital. This is another area where the adjustments could be made to try to manipulate that. So we're very concerned about the categorization or the proper classification of these investments, not just as it relates to proper valuation of gains and losses, but also to how they're classified within the balance sheet. All right, a few more items that are kind of follow-up. So FASB ASC topic 820 has a fair market or fair value hierarchy. So level one is called mark to market, which mark to market is pretty straightforward. You've heard this term before. Mark to market just basically says that we're going to quote or we're going to value the securities at their quoted market price. So a share of Amazon stock is going to be worth whatever a share of Amazon stock is currently trading for. Okay, that's pretty easy. All right. And again, keep in mind this is an entity that's bought the share of Amazon stock and holds as investment. Then we have something called mark to matrix. Mark to matrix is a little bit more subjective. It means that there is no current market for the item, but we have similar items that are traded that we can use to determine value. So say we have a company that's very similar in structure to Amazon, but is not publicly traded, and we've got an investment in that organization. We can use the Amazon valuation to make the determination of what that investment should be valued at. It's a little bit more subjective in that regard. It's not necessarily straightforward. Then we have something called mark to model. Mark to model is really highly subjective. A lot of estimates involved there. This is basically saying there is no existing market for the traded assets. So it requires management's judgment and an estimation to be able to determine what is going to be the proper valuation. Why is this relevant to us as auditors? Should be fairly obvious. Auditors hate subjectivity. We're required to learn about subjectivity because we have to learn how to treat it, but we would rather use more objective inputs than subjective inputs. The problem is that we move from level 1 to levels 2 or 3. We're replacing objective measures with increasingly subjective measures. So that's the problem there. What is going to be the solution here? If we get more subjective, then we may have to require specialized personnel to come in and do some analysis to determine if the valuation is appropriate here. So the last thing we're going to talk about is how do we audit fair value measurements. So we first of all need to understand that we've got to obtain an understanding how management makes the fair value measurements. So we need to have a detailed understanding of what management is doing in their process for making these calculations. Then if it becomes really, really challenging, say that they're doing mark to matrix or mark to model measurements, we need to determine the specialized knowledge is required. We may have to hire an actuary or hire a specialist within the firm to actually perform those transactions for us. The next step is to test the entity's fair value measurements and then evaluate whether the reasonableness of those fair value measurements are reasonable. This is going to be very similar to how we would test an analytical procedure. We would develop our own estimate, our own calculation of what those amounts should be. We're going to compare them what the management team has put in the financial statements, and we're going to test the difference. If that difference is not substantially different, then we can say we're comfortable with this value. Now you'll notice this sounds a lot like analytical procedure testing. This is not analytical procedure testing. This is much more in-depth and involved. Would require looking at the inputs and developing a much more complex model. But in essence, it's just a very, very heavily complex analytical procedure that's going to require a lot of specialized skill sets to be able to calculate it. That's it. I have nothing more new to teach you. All right, so we are done with lectures for the semester, but we have homework on Friday, so I'll see you all then.